Investing in shares based on anticipation of future needs and changes can potentially yield profitable results, but it does not guarantee success due to the inherent fluctuation of share values. One significant trend is the growing middle class in countries like India, leading to increased spending on luxury goods, technology, cars, wines, and similar products. However, accurately predicting these areas involves a certain level of speculation. Successful predictions can result in long-term benefits, but investing in a popular theme does not guarantee success, as some companies thrive while others fail. It is crucial to remember that for every successful company like Netflix, there is a failed one like Blockbuster, and for every iPhone, there is a BlackBerry. In the future, one of the big themes we can expect to see is the continuation of the technology revolution. The shift to online services and products will continue to grow, with more and more industries embracing digital platforms. This is fueled by the convenience and accessibility that the online world offers to consumers. Alongside this, there will also be an increasing emphasis on innovation driven by the need for enhanced cybersecurity. As technology advances, so do the threats, making it crucial for companies to develop effective ways to protect their systems and data. Additionally, the market for wearable technology is expected to expand further in the future as consumers continue to embrace smartwatches, fitness trackers, and other wearable devices. Another significant theme for the future is the transforming healthcare demand. With longer life expectancies in developed countries, there will be evolving needs among the aging population. This will require innovative solutions for providing quality healthcare services to this demographic. Moreover, emerging markets with expanding middle-class consumers will witness a surge in demand for healthcare. Meeting the healthcare needs of these populations will be critical for companies to capitalize on this growing market. Identifying the companies that can effectively cater to these changing demands will be key for investors and businesses in the healthcare sector. The transition towards sustainable energy sources will also shape the future. As the world seeks to combat climate change, electric cars are emerging as a prominent solution. The demand for these vehicles will continue to rise as consumers and governments prioritize environmental sustainability. Furthermore, clean and renewable energy sources such as hydro, solar, and wind power are gradually transforming the energy market. This transition presents both challenges and opportunities within the sector. Companies involved in renewable energy will have to adapt to new regulations and innovations, while also capitalizing on the growing demand for sustainable energy solutions. Overall, the shift towards sustainable energy sources will reshape not only the way we power our world, but also the business landscape within the energy sector. But note that our courses on the future of energy show that these trends are limited by resource overshoot. Doing our courses will help you to understand energy on a deeper level than most stockbrokers. You can do them by visiting our link to the Future of Energy College. The world's biggest and most profitable brands have a compelling reason behind their success. Peter Lynch, a renowned investor, demonstrates this through his investment in Dunkin' Donuts, driven by his love for their donuts. The beauty of investing in familiar and beloved brands is that it is accessible to anyone. Your personal experience holds the same value as that of an expert investment analyst. An exemplary case of this phenomenon is seen in the rapid success of Fever-Tree, a tonic drink producer that emerged just 15 years ago. Prior to its inception, Schweppes dominated the market for G&Ts. However, Fever-Tree has since become the leading global supplier of premium carbonated mixers, distributing its products to over 70 countries worldwide. In our daily lives, we rely on certain products or brands that have become indispensable. These are the items that we use every day and cannot imagine living without. Whether it's our trusty toothpaste brand, the reliable coffee machine we start our mornings with, or the familiar smartphone brand we navigate through each day, these everyday essentials shape our routines and provide us with comfort and convenience. In our quest for quality and satisfaction, we often come across new services or products that prove to be superior to their competitors. They enhance our lives in ways we didn't think possible and offer improved functionality, efficiency, or cost-effectiveness. So keeping an eye out for these hidden gems can be beneficial, as they can potentially enhance our daily experiences and bring us greater levels of satisfaction. When we step out for a shopping spree, we naturally observe the crowd's preference and the bustling activity in different stores. This first-hand experience allows us to gauge the current trends and demands in the market. By paying attention to which shops are busy and attracting customers, we can gain valuable insight into what products or brands are currently popular. This knowledge can guide our investment decisions, indicating which shares might be worth considering and which ones we might want to avoid. Overall, the choices we make and the experiences we have in our daily lives can serve as valuable indicators for identifying worthwhile products, brands, or investment opportunities. Whether it's relying on our beloved everyday essentials, discovering superior alternatives to existing services, or observing the crowd's preferences while shopping, our experiences hold the potential to guide us towards greater satisfaction and potential success in various aspects of life. Purchasing shares should not be an impulsive decision. Remember, you are investing, not speculating. The more information you have about the shares you plan to purchase, the higher your chances of making a profit. Therefore, before making a purchase, it is crucial to assess whether the company you are interested in will be a good investment. One important factor to consider is the company's recent performance. It is often stated that past performance is not indicative of future returns, and this is indeed true. A rising share price in the past does not guarantee future gains. However, to understand where a company is headed, you need to have a clear understanding of its current state as well as its history. To gain insight into a company's performance, look at its latest share price and review charts showcasing its progress. By analyzing these charts, you can quickly identify whether a company is declining, growing, or stagnating. Moreover, charts can reveal any sudden fluctuations in share prices, both positive and negative. If such movements have occurred, it is essential to investigate the underlying reasons. Additionally, it is valuable to consider the statements and updates provided by the company itself. These releases can offer valuable information about the company's performance and prospects. It is also beneficial to read articles from financial press or experts, such as those available at HL, where you can find research and insights on various prominent UK shares. Another effective method to evaluate your decision is by comparing the company you are interested in with its competitors. Assess what the company does better or worse compared to its counterparts. You can utilize your personal experience with the company, its products or services. However, it is also essential to examine the company's profitability, sales, and dividend changes over time. This comprehensive analysis will provide you with a better understanding of the company and its potential. Ultimately, you may even determine that a competitive company is a better option for investment. Did some of this confuse you, perhaps? This is why it's always important to understand the jargon of stock and shares. In the City of London, the square mile, the jargon is as follows. The bid price is the price at which shares can be sold. The offer price is the price at which shares can be bought. The bid-offer spread is the difference between the buying and selling prices. The market capitalization, or MKT cap, is the value of a company based on its current share price. The dividend is the portion of profits that a company pays out to its shareholders in cash. The dividend yield is the dividend paid by a company as a percentage of the share price. Note well that dividends may vary and are not guaranteed. Companies are not obligated to pay them. The FTSE 100 is an index of the 100 largest companies listed on the London Stock Exchange. The price-to-earnings, or PE ratio, is a ratio used to value a company based on its share price and profits. Note well that a lower PE ratio may suggest better value, but it could also indicate poor prospects and should not be the sole factor considered. Stamp duty is a government charge on share purchases in the UK, 0.5%, and for Irish companies, 1%. And there you have it. We hope you liked this video and will smash the like button and subscribe.